Is the sound coming through okay? Give me a thumbs up. Terrific. It is an honor and a privilege to address Nexia once again. A few years ago, we got a referral from Nexia and the Grand Caymans team, which led to the sale of a Napa Valley vineyard. And I believe that's one of the largest cross-border investment banking referrals in the Nexia example. It was a terrific case and a very exciting transaction, and frankly, one of the nicest closing dinners I've ever had. Today, we're going to talk about NJOY. And my understanding as we were setting this up is that vaping and e-cigarettes have become an issue growing rapidly around the globe. So I hope it's pertinent. And Sam, I will let you know when to turn it over. Thank you for that slide change. Timing was perfect. NJOY was really the second independent e-cigarette company, vaping company in the United States. They took a slightly different approach in a very competitive market. The major tobacco programs that already had conventional cigarettes didn't really care what the FDA thought because they were fighting the FDA all the time. That's the safety regulator in the United States. But NJOY took a different approach. They funded a great deal of research at universities and got support of the FDA. And while they could not say that the e-cigarettes and the vaping was safe or even safer than regular cigarettes, the data certainly backed that up. Otherwise, management was very aggressive in terms of getting out the distribution. And unfortunately, without adequate testing, they launched Kings 2.0. And it is hard to find such a complete failure in business because Kings 2.0, based upon previous success, was a complete failure. It didn't have a flavor. In fact, in polite company, I wouldn't say what the vaping tasted like. The coloration was poor, the battery life was poor, and it didn't vapor correctly. So NJOY suddenly was facing $80 million in product returns, and that completely absorbed all their liquidity. So they couldn't go forward after that. And they filed for Chapter 11 to do an expedited sale under 363 of the code. I'll also mention, just as an aside, that it was a lightning engagement. And by that, I mean, excuse me, we got a call on Wednesday afternoon. We pitched the board on Thursday. We got engaged on Friday, and they filed Friday afternoon. As you can see from the next slide, NJOY was never positive EBITDA, but the pre-money valuation talks were in the $1 billion range, which I think is an interesting study. In, back in my day when I was beginning my career, everybody was doing a multiple of cash flow. Frankly, a multiple of cash flow, not even a multiple of EBITDA. And the capital markets have changed with the dot-com world, so that a story was good enough. They had $88 million in sales in 2013, and the distribution channels had expanded so that you could buy NJOY product pretty much at any gas station in the United States. This is referred to as a fallen angel, in that it was a very popular story in the capital markets before it ran into trouble and ran out of liquidity. Next slide, Sam. You may be familiar that in the United States, there are two pathways to a reorganized company under Chapter 11. At the beginning of my career, most restructurings went through a plan of reorganization, which meant the professionals negotiated with all of the stakeholders, came up with a compromise, came up with a disclosure plan, and put that disclosure plan to a vote to the bankruptcy judge. Probably 25 years ago, the stalking horse under 363 became the preferred solution to sell assets 363 is a section of the U.S. Bankruptcy Code that's really quite short. It's just a couple of paragraphs, but it was primarily designed to sell single asset real estate or single asset hotels, and clever investment bankers and attorneys figured out how to sell very complex going concerns. This is a bridge that describes the 363 M&A process. And you can see over on the left-hand side of the slide, what you're looking for is somebody who has the ability and desire to close, the financial resources to perform, and some credibility with management. The orange box above that, they get empowerment from the fulcrum security, and all corporate recovery professionals understand the fulcrum security is sort of the last one that's in the money, and they're trying to decide what direction of the case goes. There is preliminary due diligence, and then the structuring and pricing of a stalking horse bid. And if you can find a stalking horse bid, then you can tell the market that this enterprise that's in Chapter 11 is going to emerge. What you don't know is which party is going to prevail at an auction. The stalking horse bidder negotiates the term sheet, and usually for their brain damage of getting that exposed to higher and better offers, they get a breakup fee and some expense reimbursement. They may find some additional financial partners. And then the blue box at the top with the arrow is there's a bankruptcy filing, and somebody such as CohnReznick Capital, which the FINRA licensed affiliated investment bank of CohnReznick, comes in and runs an aggressive marketing process. You do come to an auction, and the highest and best party emerges from the auction. The stalking horse bidder has the opportunity to increase their bid or take up their breakup fee and go home. And hopefully when you get to a closing in a relatively quick cycle, you have acquired assets that are free and clear of the bankruptcy process. It's a clean balance sheet. If you've done a good job in the plan, you've streamlined some operations, and you're buying things at a compelling valuation. The role of the investment banker, Sam, is to drive a transaction when time and money are in short supply. As those of you who know me know that I'm not particularly good at my diplomatic skills, but I'm pretty good at driving a process. One of the challenges that we always have is we have imperfect information. That's likely why it's in bankruptcy. I talk about overcoming insufficient timelines. What a happy banker does in a month, I have to do in a week. We have to figure out where the value is and create the illusion through a process of value. We've got to identify the right investors, the people that are going to be interested in this, and hopefully you do this in such a way. And I'm seeing a question here, and I can't see all the question. I just see the illusion of value. Hold on a second, Lee, take that. Do you remember 2 and 3 points that were part of the illusion? Well, I mean, the illusion of value, that issue depends on where you are in the cycle. There was certainly an illusion of value in that this was a high growing industry. Once it goes into bankruptcy, and as you'll find in this case, the value prospects change. And hopefully the investment banker is doing this in such a way that he hasn't burned all the relationships, burned all the bridges, so that we can proceed forward. So let me take you through what we actually did in the expedited sale process. Next slide, please, Sam. It is often the case that the investment banker in the United States has to start a marketing process before the engagement is approved by the courts. So we signed our engagement letter and built a due diligence room, populated the online data room, created our collateral marketing materials. Fortunately, the company had a lot of that before it became a debtor, and identified potential buyers. And in almost all cases, we have a number of buyers who are sort of interested in the process. Bids were due 40 days from the bankruptcy filing, and the auction was scheduled for November 2nd. We got to 134 potential bidders, sent 124 non-disclosure agreements, got 23 signed up, had 21 management presentations, 7 management meetings, and at the end of the day, we received 5 bidders. The auction began at 10 a.m. on November 2nd. It finished at 11:22 p.m. that day. We had 4 bidders. We had a couple of big tobacco companies that were interested in certain assets, specific assets. And then we had two buyers who were en bloc bidders. They wanted the whole enterprise. And we would begin the auction. We would take breaks to talk to various groups. We would reconvene several times throughout the day. There was a bank reporter, a court reporter, who was keeping a record of it for the court. And the biggest challenge was that Homewood Capital, who was sort of leading the other bidder process, didn't have their financing clearly defined. And it was really not until 8 o'clock that we got a verbal commitment from a provider of capital that gave the debtor confidence that if we selected Homewood Capital, they would in fact be able to close the deal. And after a long process of debating back and forth and consulting with the creditors committee, Homewood Capital and CGP, Solterra was determined to be the highest and best, and a group called Sadia was known as the second highest, or the backup bidder. Next slide, please. Ex post facto, the transaction closed with Homewood Capital and CGP for $39 million. That enabled the committee to, the debtor to repay the DIP. The case was administratively solvent, got a modest recovery for the unsecureds, and less than 1 year later, the next financing was done at that $1 billion pre-money valuation by Morgan Stanley. Again, NJOY holds a contract with the National Institute of Drug Abuse to supply research. It's a standard for what the electronic cigarettes should look like, and they are projecting enormous potential in the United States and around the world. They are currently in the United States, Canada, England, and the United Kingdom. The bidding process took about 13 hours with 5 bidders. My recollection was that the bidding process, the lead changed about 25 times. And again, it's a process of getting the story out, talking to the attorneys and the business people about what they want to do. I don't know that there is any kind of relationship between the number of non-disclosures sent and the NDAs that are executed. It is deal specific. This particular instance that we sent the proposal, the marketing material, to a lot of consumer product type companies or private equity that had a consumer product emphasis, and not everybody wanted to be involved with vaping and electronic cigarettes, and that's kind of a philosophical thing. This was one of the few engagements that I ever worked on that I didn't sample the product. Rest assured that when I did the Napa Valley Vineyard, we sampled plenty of product, but not in this case. Sam, last slide, please, I think. Yeah, you don't have to look at my my mug.